While mainstream financial networks assure you that inflation is cooling and the global financial system is completely sound, the background tells a dangerous story. Behind closed doors, global central banks are executing an unprecedented move. They are quietly dumping hundreds of billions in US Treasuries and simultaneously buying physical gold at the fastest pace in monetary history. Think about it. Why are the very institutions that print fiat money scrambling to get rid of it? They know something you don't, because behind the headlines of economic stability, a silent economic warfare is raging. From Beijing to Moscow and across the Middle East, the giants of global finance are abandoning the Western debt standard. They are preparing for a paradigm shift that will catch the average retail investor completely off guard. The question is, are you ready for what comes next? To discover where the world is actually heading, we have to ignore what politicians tell us. We have to follow the smartest, heaviest money on the planet. And right now, that money is leaving a trail that should alarm every single investor in the West. The official numbers are finally out. Data from the World Gold Council reveals a staggering paradigm shift. The central banks of the BRICS nations, alongside major sovereign wealth funds in the Middle East, are buying physical gold at a velocity we have not seen since the collapse of the Bretton Woods system. They are vacuuming up supply from Western vaults, meaning tons of physical bullion are migrating from west to east every single week. But that is only half of the story. If you overlay this massive gold rush with official data from the Federal Reserve Bank of St. Louis, a chilling structural divergence appears. While the line on the gold chart climbs vertically, the line representing foreign ownership of US Treasury bonds is locked in a multi-year downward trend. The world's largest economic empires are systematically reducing their exposure to the world's reserve currency. This is not a regular market cycle. This is a quiet, deliberate financial evacuation, and this is where things get dangerous. For nearly 8 decades, global central banks treated U.S. government debt as the ultimate safety net. Holding a U.S. Treasury bond was considered as good as holding cash, but with a guaranteed yield. It was the risk-free foundation of international trade, but a single geopolitical decision changed the rules of global finance forever. When the Western Financial Alliance chose to freeze $300 billion of Russia's sovereign foreign exchange reserves, they thought they were just punishing an adversary. Instead, they triggered a quiet panic inside every non-Western capital on Earth, because behind the headlines, every major sovereign leader looked at that decision and realized a terrifying reality. Your dollar reserves are not actually your assets. They are merely credit entries on a digital ledger controlled by a foreign power. If your domestic policy, your resource management, or your geopolitical alignment conflicts with Washington's interests, your wealth can be turned off with a single keystroke. The weaponization of the dollar did something that inflation alone could never do. It shattered the illusion of legal custody and introduced an unacceptable layer of custodial risk to the global banking structure. Suddenly, holding digital debt issued by a foreign nation became an existential threat to sovereign independence. The market reaction was immediate, systemic, and irreversible. We are currently witnessing the great asset migration, where the global economic chessboard is rotating out of digital debt-based financial assets and into physical, non-custodial, tangible assets. The difference between these two asset classes is everything. A digital U.S. bond requires trust. Trust in the issuer, trust in the clearing banks, and trust in the stability of the legal framework. It is an asset that represents someone else's liability. Physical gold requires zero trust. Gold cannot be hacked by an adversary. Gold cannot be frozen by an emergency economic decree. And gold cannot be diluted by an overactivated central bank printing press. When a sovereign entity sells a U.S. Treasury and uses that fiat cash to buy a physical gold bar, they are converting an elastic political promise into an inelastic piece of matter. They are buying absolute sovereignty. This massive structural rotation explains exactly why physical precious metals are disappearing from Western markets and landing in Eastern central bank vaults. The insiders are securing their perimeters and building an economic fortress that is completely immune to Western paper market manipulation and political sanctions. The global financial order is being fundamentally re-engineered right in front of our eyes. The institutional creators of fiat money are abandoning the very system they created, leaving the public to hold the bag of an eroding currency standard. But this geopolitical exodus is merely the first catalyst of the coming storm.
Because the motivation for this historic asset migration isn't just driven by geopolitical fear, it is driven by a cold, calculating look at the ledger. The insiders are running away from the dollar because they have done the math, and they know that the mathematical endgame for Western debt has finally reached its absolute limit. The mainstream media wants you to believe that central banks are hoarding gold simply as a tactical hedge against short-term market volatility, but that's not the real story. The insiders aren't speculating, they are calculating. They are looking directly at the explosive, unpayable sovereign debt balance sheets of the United States and Europe, and they realize the system has crossed the mathematical point of no return. Let's look at the raw, cold data. The U.S. national debt is accelerating at a pace that breaks all historical precedents, expanding by billions of dollars every single day. But the true crisis signal isn't just the total size of the debt pile, it is the compounding cost to service it. Annual net interest payments on the U.S. debt have exploded past the historic $1 trillion threshold. Washington is now spending more money just covering the interest on its old debts than it spends on its entire national defense program or major domestic safety nets. This is a structural debt spiral. To pay the interest on the old debt, the Treasury must issue brand new debt. And this is where things get dangerous. The Federal Reserve is trapped in a catastrophic paradox. If they keep interest rates elevated to combat sticky inflation, they rapidly accelerate the insolvency of the federal government by driving interest costs higher. But if they aggressively cut rates to rescue the Treasury, they unleash a massive secondary wave of currency debasement. The architects of the monetary system know there is only one mathematical escape route left from a sovereign debt trap of this magnitude: financial repression. Behind the economic jargon, financial repression is a quiet, deliberate transfer of wealth from the public to the government. The central bank must purposely keep nominal interest rates lower than the actual real rate of inflation. By maintaining negative real yields, the government slowly burns away the purchasing power of its own debt using inflated paper currency. But in doing so, they systematically destroy the purchasing power of your savings account. Central banks understand this endgame scenario perfectly. They are aggressively buying physical gold because they know that in an era of negative real yields, fiat paper money is a melting ice cube. Yet, while the elite lock down the gold market, an even more violent structural divergence is quietly playing out right next to it: the silver market. According to the latest comprehensive data from the Silver Institute, the global silver market is currently locking in its 6th consecutive year of an industrial supply deficit. Cumulative shortages over this cycle have already drained hundreds of millions of ounces of physical silver out of above-ground inventories. The driving force behind this structural deficit isn't just retail demand, it is the physical backbone of the modern world. The global energy transition and the explosive build-out of artificial intelligence infrastructure are consuming silver at an exponential rate. Every advanced electrical transformer, every solar photovoltaic panel, and every single high-performance AI data center chip requires silver, as its physical conductivity cannot be thrifted or easily substituted. We are looking at a massive structural supply-demand mismatch. Yet, if you look at the paper futures market on Wall Street, the price of silver has been repeatedly compressed, kept locked within artificial trading ranges. Why this massive contradiction? Because the paper market allows institutional desks to trade synthetic, unbacked paper contracts, essentially selling silver that does not exist in physical reality. And this brings us to the ultimate counterpoint. Mainstream wealth advisors and traditional fund managers will look at you and say that precious metals are dead assets. They will tell you that gold and silver are inefficient because they pay no dividend, yield no interest, and generate no quarterly cash flow. But their logic completely falls apart when a system hits its mathematical limit. Yield and dividends only matter if the underlying currency holds its value and if the counterparty promises to pay you back can be trusted. When the sovereign debt of the world's largest superpower begins to resemble a compounding debt trap, the risk profile changes entirely. When systemic counterparty risk peaks, a zero-liability asset becomes the most valuable asset on Earth. A paper contract on an exchange is someone else's liability. A digital deposit in a commercial bank is someone else's liability. Physical gold and silver in your possession represent absolute, unencumbered financial sovereignty. The insiders are trading the illusion of digital yield for the security of physical scarcity. They are preparing for a profound dislocation between the paper price of assets and their true physical value. Because behind the scenes, this massive accumulation of hard assets isn't just about surviving the next inflation report. It is the foundational preparation for a complete global monetary reset. The insiders recognize that the current fiat experiment, which began on August 15, 1971, is approaching its systemic expiration date.
The world embarked on an unprecedented monetary trial, an international financial system backed by absolutely nothing but political promises and compounding debt. For over 5 decades, that system appeared to function, but history shows us that zero fiat currencies survive indefinitely. And this is where things get dangerous. The current macroeconomic landscape is beginning to mirror the dark, structural stagflation era of the 1970s, but with a terrifying twist. Back then, the United States was a creditor nation with manageable debt to GDP levels. Today, the West is buried under a mountain of leverage that cannot be mathematically repaid under current economic growth projections. The global financial architects are not waiting around for an accidental collapse. They are actively scripting the transition. The bigger implication of the massive silent gold rush by global central banks is that they are front-running the creation of a new international monetary architecture. This upcoming reset will not look like a traditional gold standard with circulating coins. Instead, it is highly likely to take the form of central bank digital currencies, or CBDCs, linked to multi-commodity baskets, where physical gold and tangible commodities act as the critical capital backstop to project international credibility. While the East builds out this commodity-backed, sanctions-resistant parallel network, a massive divergence is opening up in investor psychology across the globe. And this is where the vulnerability of the average retail investor becomes completely exposed. In the United States and Europe, mainstream market participants are currently suffering from severe risk numbness. Conditioned by over a decade of central bank interventions, emergency bailouts, and artificial liquidity injections, investors have developed a false sense of security. They are aggressively chasing tech stocks and hyperinflated AI growth narratives, completely blind to the fragility of the underlying plumbing. They believe the paper wealth displayed on their brokerage screens is completely secure because the market indices are touching nominal highs, but they are confusing nominal gains with the real preservation of purchasing power.
Because behind the headlines, the ultimate chess masters, the very institutions that control the supply of money, are quietly building financial bomb shelters out of hard assets. They are securing real-world sovereignty while leaving the public completely exposed to the digital ledger risks of the next major crisis. This is the classic illusion of knowledge. Retail investors watch financial media and think they understand market mechanics based on historical patterns of the last 20 years. They assume that if a crisis hits, they can simply rotate into cash or sell out at the top. But they fail to realize that when a monetary reset occurs, the liquidity trap snaps shut instantly. When the underlying currency itself becomes the source of systemic risk, traditional paper hedges stop working. If you are holding digital representations of wealth inside a highly concentrated, fragile banking infrastructure, you do not own an asset. You own a digital claim check that can be frozen, restricted, or bail-in targeted during an emergency. The insiders understand this rule perfectly. That is why they are not hoarding tech equities or digital bank liabilities. They are executing the exact same playbook used by historical elites during every major monetary transition in human history. They are buying physical weight. They are accumulating physical gold because it acts as a non-custodial anchor of value, and they are monitoring the structural silver deficits because they know that industrial demand from the advanced technology sector will strip the physical market bare. The writing is on the wall, but it is written in numbers and capital flows, not in mainstream media soundbites. The monetary paradigm we have inhabited since 1971 is running out of time. The debt loop is accelerating. The weaponization of the financial system has fractured global trust, and the central banks are positioning themselves for the inevitable endgame. The global elite are quietly moving their capital to safety before the rules of the game are rewritten overnight. They have already made their choice. They have chosen physical sovereignty over digital promises. As the structural cracks in the global debt matrix continue to widen, the window of opportunity for the average individual investor to follow the insiders and secure their own financial perimeter is rapidly closing. At the end of the day, actions will always speak much louder than words. When the very institutions responsible for printing fiat money are frantically trading their own paper currency for physical gold and silver, you are looking at the ultimate warning sign. It's an explicit signal that the current economic architecture is approaching its final hour, because behind the headlines, the foundation is cracking. When the collective illusion of confidence in unbacked fiat money completely vanishes, the massive global debt matrix will disintegrate like a row of dominoes. And this is where you have to ask yourself the hardest question. Are you truly willing to keep betting your entire life's work, your family's financial security, and your accumulated wealth on digital digits blinking on a commercial bank screen, especially when the people who manage that exact system are quietly securing their own escape routes? Don't wait for the mainstream financial networks to tell you it's time to move. By then, the liquidity trap will have already snapped shut. The time to construct your personal financial perimeter is while the exits are still wide open. But I want to hear from you. How are you restructuring your portfolio to defend against this silent monetary migration? Do you think we'll see a gold-backed digital reset, or are we heading towards a chaotic inflationary collapse? Drop your thoughts in the comments section below. I read every single one. If you found value in this deep dive, make sure to hit the like button, subscribe to the channel, and turn on the notification bell so you never miss our next macroeconomic update. Stay vigilant, protect your sovereignty, and I will see you in the next video.